Do you want to save a significant amount of money on your monthly mortgage payment? Then you have to get rid of your mortgage insurance, and I'm going to tell you how. I'm Shaheedah Hill, getting you over the hill to home ownership and helping you confidently buy your first home. So we're going to talk about what exactly is mortgage insurance, the two types of mortgage insurance. But if you know that you're going to get either a conventional loan or an FHA loan, and you're really concerned about one or the other, I'm going to begin with conventional, but there's going to be a link below to FHA. So if you want to start with FHA, click the link below. So first, what is mortgage insurance? It is insurance that you pay that helps protect the lender if you default on the mortgage. So it's insurance for them. It doesn't protect you. Is if you're in default, they're going to pay your payments or something like that. It is just for the lender. Now, when do you pay it? We're going to start with conventional loans. With conventional loans, mortgage insurance is called PMI, private mortgage insurance. For FHA loans, it's called MIP, and that's a mortgage insurance premium. So let's talk about how to get rid of it if you are getting a conventional loan. Now, first, if you put down 20% or more on your home, you don't have to pay mortgage insurance, but you have to run the numbers to see if it makes sense to put down 20% to avoid the mortgage insurance, or to use that money in other ways if you don't want to put down 20%. But if you want to avoid it altogether, if you put 20% down on a conventional loan, you do not have to pay the private mortgage insurance. However, if you're like most first-time home buyers, you're putting less down than 20% and you will have to pay PMI. So I'm going to tell you exactly 3 ways that you can get rid of your PMI. Now, I will have to say that one of these ways is my favorite because I did it myself. Number 1 is pay down the mortgage to less than 20%. As if you pay down your mortgage to less than 20%, you can contact your mortgage company, inform them that you already have 20% equity through paying your mortgage down, and they will get rid of your private mortgage insurance. Now, if you do not call them at 20%, then they will automatically cancel it, but they'll have until it gets to 22%. So you want to make sure that you are keeping track of when you reach that 20%. At closing, the loan documents, the loan disclosures will tell you when you should be at that 20% mark, like at what payment, what month you'll be at that 20% mark. So pay attention to that because again, they don't have to automatically cancel it by law until you get to 22%. So you don't want to make sure that as soon as you get to 20% equity, you get your mortgage insurance canceled and removed. Now, number 2, this is my favorite because you can get rid of it even earlier. It's to have the property reappraised. This is what I did with my house after about year 3 of my mortgage. Not only was I paying it down, but it was going up in value. It was worth more every year. When I had enough equity, my value had significantly increased, even though I didn't pay that much down. I contacted my mortgage company and I said, I want my home reappraised to get rid of the private mortgage insurance. The mortgage company will send an appraiser out to confirm your home's value. And if you indeed have at least 20% equity in the home. So that's what I did. They sent an appraiser out, they confirmed the value, and then probably the next month, that next month's payment, I didn't have to pay the private mortgage insurance anymore. So this is something that you need to do. Even if you're not sure, you need to contact your mortgage company to figure out when can you do this. I had some clients of mine call their mortgage company and some of them said they had to wait 2 years. Some people said they didn't do it at all until they got to the 20% and pay down. So you want to know how your mortgage servicer handles this. But a lot of mortgage companies will have the property or the ability to have the property reappraised to see if you've reached that 20% in equity. Now, if you're not sure, you can reach back out to your real estate agent, the one that helped you buy the house, and they can kind of give you an idea of the value and if you should go ahead and pay for the appraisal to get it reappraised. Now, you cannot hire your own appraiser. The mortgage company will send out their appraiser. You will pay for it, but then they will check the value of your home. So make sure that you are contacting your mortgage company so you know exactly how it works for you and your mortgage. If you have any questions, again, put them down in the comments. The third way to get rid of your private mortgage insurance for conventional loans would be to refinance the loan. So if you refinance the loan and you have at least 20%, then they will cancel your mortgage insurance, or they won't even have mortgage insurance. But you have to be careful with refinancing. Generally speaking, it only makes sense to refinance a loan if you're saving an interest rate at least 1%. But if interest rates are higher than your current rate, and even if you're getting rid of your PMI, it may not make sense for you to refinance just to get rid of PMI if you're going to have a higher interest rate. So you want to, if you're thinking about refinancing, you need to get a quote from the lender that's going to refinance so you can compare what your new mortgage payment will be. This is very, very important. Not all refinances make sense. There's also closing costs with refinances. So you want to make sure that you're doing all of your homework before you refinance. Now let's get into FHA loans and how it works for FHA. FHA loans definitely do not have it as good as conventional loans. It's not as easy to get rid of your mortgage insurance. Now, FHA mortgage insurance is called MIP, or mortgage insurance premium. And I'm also going to give you some examples of how much you're likely to pay for PMI and MIP. So stay till the end. Now, for FHA loans, unless you put 10% or more down, mortgage insurance is permanent. You will pay it for the life of your loan. The only difference really for FHA is if you put 10% or more down, you will pay mortgage insurance for 11 years. So you won't do it for the entire time. You'll pay it for the first 11 years. Now, if you put less down than 10%, like a lot of FHA buyers, you will have mortgage insurance for the life of the loan unless you refinance to a conventional loan. So it's very important for you to know that you have this permanent insurance. Now, with FHA mortgage insurance, it will go down because the percentage that you pay, and we'll talk about percentages shortly, the percentage that you pay is equal to your loan amount. So as you pay down your loan, then the percentage doesn't change, but because your loan amount has changed, the amount you pay for insurance will be less. So, it's not that you're going to be paying the same amount for the life of the loan, but you will be paying mortgage insurance for the life of the loan. Again, as I said with a conventional, you can refinance to a conventional loan to get rid of mortgage insurance if you have at least 20% equity in the home, but you have to make sure it makes sense for you to refinance. Typically, it only makes sense for you to refinance if you're saving at least 1% in interest, not just getting rid of your mortgage insurance. So you want to run those numbers with your lender to see if it makes sense. Now let's talk about some numbers. Exactly how much money are you typically going to pay on either FHA mortgage insurance or conventional mortgage insurance? Here's an example for a $200,000 home. FHA loans, the percentage for mortgage insurance is about 0.85% of the loan amount. So this will cost you about $141 a month. For conventional, the PMI amount varies by credit score, loan to value, and debt to income ratio. So it could be anywhere between 0.58% or 1.86%. So when you get your loan estimates, I'm going to recommend a few different videos after this one, but once you get your loan estimates, you'll have an idea of how much you're paying for conventional mortgage insurance and for FHA mortgage insurance. But for conventional, for a $200,000 home, it could be anywhere from $96 a month to $310 per month. But again, it will depend on your credit score, your loan to value, and your debt to income ratio. Now, there are a few videos that I recommend that you watch. Number one is how equity works. So if you're not sure how much equity you have in your home and how equity works, please watch that video. And another video that I recommend that you watch is this video about how to get the best rate and the best terms with your lender and what you should be asking your lender for. One of the things you should be asking for is for them to compare FHA versus conventional. I did a video on that as well, but you also want those estimates, those loan estimates, so you can compare FHA versus conventional. So please watch those videos next. Please like and subscribe to my channel for new videos every week.